Welcome to topic 4 of the balance sheet, part 3. So in the part 3 video, we're going to understand how to classify assets and liabilities. We'll also understand how to measure them, measure assets and liabilities, but only in a really simplistic manner. And then lastly, we'll have a look at the different balance sheet formats that can be used. So first of all, classifying our assets and liabilities. So the information that gets provided on a balance sheet can be made more useful to the user by classifying the assets and the liabilities as current or non-current. So we break them into two groups. So this classification is in order of liquidity. Okay, and what we mean by liquidity is the amount of time that it takes to convert the item into cash when we're dealing with assets, or the amount of time that it takes us to pay the cash. So in regards to liabilities. Current assets. Our current assets are consumed or converted into cash within the operating cycle. So it's usually within a 12-month period. Examples, cash, inventory, accounts receivables, prepaid expenses. So they're like your really liquid, your really short-term types of assets. So you're going to consume them or convert them into cash within a shorter period of time. So generally less than, or say 12 months or less. Non-current assets. So with our non-current assets, usually with these ones, we hold them for the purpose of generating wealth, okay, for income, rather than reselling them. So it means we're going to hold on to them for a bit longer. So it's going to be more than 1 year. So examples of non-current assets are things like land, buildings, equipment, patents, goodwill. So they're longer term. So I guess the simplest way to think about current and non-current is current, less than 12 months, non-current, greater than 12 months. Now looking at the liabilities, so our current liabilities. So these guys are amounts due for repayment to outside parties within 12 months of the balance sheet date. So examples here are like your accounts payables, your wages payables, accrued expenses, revenues received in advance. Non-current liabilities. These ones are amounts due to other parties which are not liable for repayment within the next 12 months. So that's your longer term debt. So it could be a bank loan, okay, a bank loan, or say a 3 or a 4 year bank loan. Okay, so it's not due for repayment within the next 12 months. So yes, you may have your repayments, so your fortnightly or your monthly repayments that you're making on that loan, which that's part and parcel of having a loan, is you make regular repayments, but the ultimate due date on the full amount is in, say, 3 to 4 years' time. So that's where that's what you're looking at in terms of that final settlement date, all right, in terms of being able to classify. So loans payable, mortgages, or your mortgage payable. So some points to note. The classification depends only on the period of time for which the liability is outstanding. So coming back to the example of that loan, of that 3-year loan. Yes, you're making your smaller repayments throughout that time, but ultimately the loan is due in 3 years' time. So the purpose of the liability as well does not determine whether the item is current or non-current. It is purely timeframes. Okay, so that's what you need to be looking at. That's what you need to be thinking about when you're going to classify an asset or a liability as current or non-current. Now looking briefly just at measuring assets and liabilities. So the values on our balance sheet are what we call the carrying amount, or the book value, or the written down value. So these all more or less mean the same thing, and they can be quite interchangeable. So there's a number of different ways that we can measure assets, and we've got various rules about how we do measure particular items. So some possible measurement options that we've got here is, say, if we take historical cost. Historical cost is the original cost of an asset. So it's what we initially record our assets in the books as. Current cost, so that's the cost of replacing an asset. So we may measure our asset in that regard. We can measure our assets using market value. So that's the expected cash from selling an asset. So when we use market value, firms are said to be revaluing that asset. Okay, so if you recall, that results in a reserve in owner's equity. We can measure our assets at present value, so that's discounted cash flows. Some examples of measurement rules include, we have accounts receivable. So this is the amount owing by debtors and that can be reduced by an allowance for doubtful debts. So that allowance for doubtful debts, that's an estimate of money that we can't collect from our customers. Okay, in a perfect world, all of our customers would pay us what they owe us. But unfortunately, it's not always a perfect world, and sometimes things go bad and not everyone can pay their bills. So it's pretty much inevitable. So if you're going to go into business for yourself, just be aware you're going to have some customers that won't always pay up. Okay, so on the balance sheet, we create what's called an allowance for doubtful debts, where we estimate the customers we expect not to pay, and we'll subtract that off of our accounts receivable, and we'll disclose net accounts receivable. So also note the word net. So as I said before, if you see the word net, there's a calculation behind that. Inventory rules. So inventory, we must value it at cost or market price, whichever one is the lower one. So we're being conservative. So in accounting, we do have a conservatism principle. So if it's cost, then our inventory can be valued using what we call FIFO, which is first in, first out, also weighted average, or specific identification. There is a method out there called LIFO, but it's not permitted in Australia. It's illegal, so we can't use that one. In America, yes. Australia, no. If we take non-current assets, so most are carried at cost, or they can be revalued to fair value. So it is common to reduce the value of non-current assets as well by accumulated depreciation or amortization if we're dealing with intangible assets. So accumulated depreciation, that's another example of an estimate that we use in accounting. With goodwill, we do have those special rules around goodwill. So that was in the part 2 video if you'd like to go back and just have a bit of a refresh. Now, looking at the alternative formats for our balance sheet. So we cover 2 different formats here. So we have the T format. So this is the one that generally your small businesses will use. And the reason it's called a T is because it is like it's in the shape of a T. Okay, so if you draw a T, that's the format we're dealing with here. And then we have the second format, so the narrative format. So when we get to the part 5 video in topic 4, the exercise that we do there, we're going to be using the narrative format. So here you can see the T format. You've got your current assets and your non-current assets on that left-hand side there. And then on the right-hand side, current liabilities, non-current liabilities, and then you've also got equity. Okay, so it looks similar to the balance sheets that we've looked at previously in this course to date, but here we've just got that extra level of detail where we've brought in current and non-current as well. Also note, total assets, 174,000 is equal to total liabilities and equity of $174,000. So the accounting equation is also being represented in this balance sheet, and it's standing true, which is what we always want to see. Okay, when you get it, shout from the rooftop, cheer, scream, yell, get excited, because it's great, okay? It means you don't have errors in there, or at least a 95% chance you don't have errors in there, okay, with it balancing out. But if it's not balancing out, you've got a little bit more work to do just to go and figure out what went wrong. Because we do have to find it, because again, people are going to use these things for decisions. And we don't want people making incorrect decisions because they got bad information. The narrative format, or also called the report format. So this is what's used more so in your big, large, publicly listed companies. So it's why we call it more real world. So in this format, you'll see your balance sheet goes assets minus liabilities equals owner's equity. So any arrangement of the equation can be used for this format. It just depends on the owners of the business. So as I've said, A minus L equals OE. That is the most common one in practice. Or we can write OE equals A minus L. Okay, or A equals L plus OE. Okay, so any rearrangement is fine, but it's really that first one. That's the most common one that you're going to see out there in practice. So here's some visuals for you. JB Hi-Fi. Okay, so you can see JB Hi-Fi. I'm sure most of us have probably been into a JB Hi-Fi store. They are real, they do exist. So you can see they've got their current assets, their non-current assets, on the side, the time frames. So they present not only the current year, but they also present a year before that. So they're required to by the accounting standards. They have to disclose comparative information. You can see a column there that says note. So what that represents is in annual financial reports, companies, especially these big guys, they're required to present additional information that explains the numbers that appear on the balance sheet here. So note 34 will give you more information about cash and cash equivalents. So if we look now on the next slide, we've got their current liabilities and their non-current liabilities. Actually, do they show? Nope. All right, let's keep going. So you can see down the bottom there, notes to the financial statements. Note 25, retained earnings. So what you can note there with that red arrow is that from the balance sheet, it displays retained earnings as 184, 276. And then when we actually go to the retained earnings note just here, you can actually see the movements in retained earnings. So balance at the beginning, net profit, dividends that they've subtracted gives them the ending balance of retained earnings. Okay, so as I said, the notes explain the numbers in the balance sheet, and here you can see the movements in their equity. Another note to have a look at, trade and other receivables. So their trade and other receivables comes out at 60,269. So if we just pop back, trade and other receivables, you can see on the second line there, 60,269. So the notes give that extra little bit of information just to explain the numbers. So your balance sheet's like a big summary, and the notes are the details.